Warren Buffett's 3 rules for never losing money. You have to know about this. Stay until the end to find out everything. But before starting the video, leave your like and subscribe to the channel so you don't miss anything about Warren Buffett and money. Warren Buffett is known for his sharp investment acumen, but perhaps his most famous piece of financial advice is surprisingly simple. Rule number 1, never lose money. Rule number 2, never forget rule number 1. At first glance, it might sound like a clever quote or an exaggeration. After all, even the best investors in the world lose money from time to time, right? But when Buffett says never lose money, he's not talking about avoiding all risk. He's referring to a mindset, a careful, calculated approach to money that prioritizes capital preservation above everything else. Let's break down what this rule really means and how you can apply it in your own financial life. Understanding the true meaning. To never lose money means to avoid making careless or emotional decisions. It means doing your homework, understanding what you're investing in, and thinking long-term. Buffett doesn't believe in gambling or speculation. He avoids hype, trends, and anything he doesn't understand. Here's what this rule looks like in practice. Don't invest in things you don't understand. If you can't explain how a company makes money, don't invest in it. Avoid get-rich-quick schemes. If something sounds too good to be true, it probably is. Think about the downside before the upside. Ask yourself, what could go wrong, before you chase returns? Buffett has avoided countless disasters in his career, not by being lucky but by sticking to this rule religiously. Protecting capital is priority number 1. Warren Buffett sees money as a tool that, if protected, can grow through compounding over time. Losing capital not only reduces your current net worth but also destroys future opportunities for that money to grow. Let's say you invest $10,000 and lose 50%. You now have $5,000. To get back to $10,000, you need to gain 100%, not 50%. Losses set you back in a way that's hard to recover from. That's why Buffett is obsessed with downside protection. He avoids investing in companies with too much debt, industries he doesn't understand, and volatile markets where fundamentals are shaky. He would rather miss out on gains than risk permanent loss of capital. Avoiding emotional decisions. Buffett has said many times that emotional control is more important than IQ when it comes to money. Most people panic when the market drops, selling at the worst possible time. Others get greedy when markets rise and jump into investments they don't understand. This behavior often leads to losing money, not because the investments were inherently bad but because people couldn't control their emotions. Buffett's strategy is the opposite. When others are fearful, he becomes interested. When others are greedy, he becomes cautious. He stays calm, analytical, and unemotional. That's how he avoids major losses. Why this rule is often ignored. Most people don't follow Buffett's rule because it seems too slow. In a world where quick profits and fast success are glorified, taking a cautious, long-term approach feels boring. But Buffett didn't become a billionaire by being fast. He became wealthy by being smart, patient, and extremely focused on not losing money. In fact, his fortune is built more on the money he didn't lose than the risks he took. How to apply rule number 1 in your life. Here are a few ways to follow Buffett's first rule in your own financial journey. Build an emergency fund. It's the best way to avoid financial disasters. Avoid high-interest debt. The fastest way to lose money is paying 20% interest on credit cards. Research before investing. Don't follow the crowd. Understand where your money is going. Think long-term. Don't invest based on short-term hype or headlines. Remember, you don't need to be a genius to build wealth. You just need to avoid big mistakes and let time work in your favor. Warren Buffett's investing philosophy is often described as simple, but that simplicity comes from decades of discipline and deep thinking. His second major rule, closely tied to the first, is this. Never invest in a business you cannot understand. This principle may sound limiting at first, but it's actually one of the keys to Buffett's long-term success, and a crucial way he avoids unnecessary financial losses. Let's explore why understanding the business is so essential, how Buffett applies this rule, and how it can guide your own decisions with money and investing. The power of clarity and simplicity. Buffett believes that clarity is power. He has no interest in chasing flashy trends or investing in complicated businesses with confusing revenue models. If he can't clearly see how a company makes money, who its customers are, or what its competitive advantage is, he stays away, no matter how hot the stock may be. This approach is part of what he calls staying within his circle of competence. The idea is simple: only make decisions in areas where you truly understand the landscape. He understands insurance, so he invests in companies like Geico. He understands consumer goods, so he buys Coca-Cola. He understands banking, so he invests in firms like American Express and Bank of America. But when it comes to emerging technologies he doesn't fully grasp, like cryptocurrency or unproven startups, Buffett prefers to sit on the sidelines. Why most people skip this rule? In today's world of complex financial products, high-speed trading, and trendy investments, it's tempting to get swept up in hype. People often throw money into businesses just because they're popular, or because everyone on social media is talking about them. But investing in things you don't fully understand is like playing poker with your eyes closed. You might get lucky once or twice, but eventually the odds catch up with you. Buffett avoids this mistake by being brutally honest with himself. If something is outside his expertise, he admits it and moves on. This level of humility has saved him millions, possibly billions, over his lifetime. Case study: Buffett's approach to tech. For many years, Buffett avoided investing in technology stocks because he didn't feel confident in understanding them. Even though companies like Apple, Amazon, and Google were rapidly growing, he waited until he fully understood the business models. It wasn't until later in his career that he finally bought into Apple, after understanding not only the company's product ecosystem, but also the consumer behavior and cash flow reliability behind it. That investment became one of the most profitable in Berkshire Hathaway's history. The lesson? Patience plus understanding equals profit. Guesswork equals danger. How to apply this rule in your life? You don't have to be a billionaire to apply Buffett's wisdom. Here's how you can follow this rule starting today. Ask questions before you invest. How does the business make money? Who are its main competitors? Is there consistent demand for its product or service? Stick to industries you know. If you work in healthcare, maybe start by researching healthcare stocks. If you understand real estate, consider investing there. Don't fall for jargon. If a company's explanation of what it does feels vague, it's probably hiding risk. Learn before you leap. It's better to miss an opportunity than to blindly invest and lose money. The real advantage: confidence through knowledge. When you truly understand a business, you're more confident during market volatility. You don't panic when the stock drops 10% in a week, because you know the long-term fundamentals are solid. That kind of peace of mind isn't just financially smart, it also helps you stay emotionally stable, which is one of the biggest challenges in investing. By limiting his investments to what he fully understands, Buffett minimizes surprises, avoids costly mistakes, and maximizes the power of long-term growth. Warren Buffett has built one of the greatest fortunes in financial history not through speed, luck, or hype, but through time. His third core principle isn't always written out like the first two, but it's deeply embedded in everything he does. The stock market is designed to transfer money from the impatient to the patient. This mindset, thinking in years, not months, is what separates Warren Buffett from the average investor. While the world races toward short-term results, he plays the long game. And in doing so, he lets compounding do the heavy lifting. Let's dive into why long-term thinking is Buffett's ultimate edge, and how it can help you build wealth slowly, steadily, and with less stress. The compounding effect. The concept of compounding is simple. When your investments earn returns and those returns are reinvested, they start earning returns too. Over time, this creates a snowball effect where your money grows exponentially. Buffett didn't become a billionaire overnight. In fact, most of his net worth was built after age 50. He often says his wealth is the result of a combination of living a long time, starting young, and compounding. Here's the catch: compounding takes time. The biggest gains don't happen in the first year, or even the first decade. They happen in the later years. That's why patience is non-negotiable. Why most people fail to think long-term. We live in an age of instant gratification. Social media, viral investing trends, and 24/7 financial news all encourage fast thinking and emotional reactions. People chase the latest meme stock, panic during market dips, and jump from investment to investment. Buffett does the opposite. He buys businesses, not just stocks, that he plans to own for decades. He doesn't obsess over daily fluctuations. In fact, he's often quoted as saying, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. That's long-term thinking in its purest form. Time is a moat. Buffett's long-term mindset creates a moat, a protective barrier against bad decisions. When you think in decades instead of days, you're less likely to sell during a crash. You're less tempted to chase hype. You give your investments room to grow. This also means you don't need to predict the perfect moment to buy or sell. You just need to be in the game consistently for a long time. Time helps average people build wealth without needing expert-level skill. It forgives small mistakes and rewards steady habits. How Buffett applies long-term thinking. Let's look at real examples from Buffett's portfolio. Coca-Cola, purchased in the late 1980s. Still held today. American Express, long-term holding since the 1990s. Apple, a more recent buy but one that Buffett intends to hold for the long haul. These investments have paid off not just because they were good companies, but because Buffett gave them time to grow, even through market ups and downs. He doesn't just pick winners, he lets them win by not interfering. How to think long-term like Buffett. You don't need billions or a team of analysts to adopt Buffett's approach. Here's how to start. Set long-term goals. Think in 5, 10, and 20-year horizons. Invest consistently, don't wait for the right time. Ignore market noise, tune out daily headlines and drama. Trust the process. Let your money work while you focus on your career, health, or business. Reinvest your returns. Let compounding grow your wealth without interruption. And remember, wealth is a slow game. The earlier you start and the longer you stay in, the bigger the reward. Final thoughts. A mindset, not just a method. Buffett's 3 rules are more than just strategies, they're a way of thinking. Never lose money, focus on protecting your capital. Only invest in what you understand. Clarity beats complexity. Think long-term, let time and compounding do the work. These rules have guided him to success for over 7 decades, and they're available to anyone, no matter how much or how little money you start with. The only question is, will you follow them?